Hi everyone, welcome to the weekly stock market update. Slightly unusual time, but well, if it works for you, it works for me. So I am, as ever, going to ask you if you can see and hear me. Please also let me know where you're from, the usual, if it's your first time on here as well. Chaz from Wiltshire, good, I can see it. Now I'm going to share my screen on. Make sure, because I'm on a different computer at the moment, to make sure I'm doing everything absolutely correctly. There we go. You should be able to see little old me down here, and you'll be able to see the update. Now, I've got a heck of a lot of material, and some of it's quite different before because of the recent market volatility. I really want to explain a lot of different things as well to you, so give you the bigger picture. So let's start off. Now, by the way, first things first, if you'd like a free copy of this, alpeshpatel.com/links, and you can get it. Okay, so it's my book Investing Unplugged. Lots of lovely comments from, well, everything from a $2 billion hedge fund manager to Bloomberg to the Financial Times, writing lovely things about the book. So you can get it for free. Okay, so that's made it worth your while already, hasn't it, to be on today. So that's the first thing I wanted to say, and I'll also make sure that I share it with you now. So what's today about? Well, it's about not just what's been happening in the market, but I want to give you a bigger picture all the way from my Financial Times columns and years of experience. Believe it or not, that is me there in the picture. So where are we in terms of valuations? Well, the same place we've been for the last 3, 4, 5, 6 years, which is everything in red is overvalued. Well, wait a minute, Alpesh, how come Microsoft doubled in price despite you paying $25 for every future dollar of profit, whereas ExxonMobil's only $12 for every future dollar of profit is what you're paying to buy a share in Exxon? Surely we should just buy the green ones and not the red ones. Yet the red ones are the ones which have gone up over not just a year, not over 2 years, but consistently, because valuation isn't the only factor. So this is now a good stark time to remind ourselves of that. However, we will look at these relatively undervalued companies, such as these in green, to see if there's opportunities for us to get in, as long as not just valuation, but momentum and a bunch of other factors, all those boxes are ticked. Okay. I also want to start a few polls. Let's see what you all think. Let's publish this poll. Now, where are we in terms of percentage return year to date with all the sectors? Okay, and what you can see is there's a few outliers, anything on this side, and in a bull market, you'll have more outliers. There's a few big underperformers, the reason why we have stop losses to make sure we don't get those. And then these cancel out some of these. As long as you've got more small gainers than small losers, you're up. Roughly, the statistics works out that 80% of your profits in a year will probably come from about 20% of your companies. If it's a roaring bull market, which 1 or 2 years out of 7 it will be, then there'll be virtually everything will be up in your portfolio. And if it's a roaring bear market like 2022, you'll probably be holding cash. But I just wanted to share where things are. There are very few sectors where everything's up. Utilities is one of them, and we'll look at some of these, such as Duke Energy, for instance. What's also noticeable about this that I wanted to share with you all is that notice how, if you look at some of the big performers like an NVIDIA, these aren't owned by, say, a Warren Buffett or a Bill Gates and some of the billionaires. Given all the resources they have, all the clever people and all the brains, what it's really telling you is my job, their job, your job is not necessarily to guess which are going to be the big outliers, because in trying to go for those, you'll probably end up falling flat on your face. What'll usually happen is our job is to stop having any big losers by a stop loss. We'll have a bunch of small losers, a bunch of small gainers, which cancel each other out, and a few big winners, but not many. So 20% of the companies will generate 80% of our profits. And I'll show you a bit of that later on. It is not our job, because we already know we can't do it, because even Warren Buffett can't do it, is just to pick the big winners. I wish I could. I wish I had that crystal ball. Not happened. Okay. Some years it's been suspiciously easy, like last year. But then again, it was Meta, Microsoft, Apple, Amazon, Alphabet, and everybody was screaming that out. Those years next to unheard of, as you will agree, I am sure. But just because, you can throw 10 heads in a row doesn't mean you're the world's greatest coin tosser either. Okay. These are the earnings calendar coming over for the next 7 days. There is nothing on here which is going to move the market itself. If the market wants to make excuses to take profits, it'll find those excuses. But Eli Lilly's earnings and Walt Disney's, which happened before market open, or anything after market close, which will be whilst this webinar is going on, none of these are going to move the markets. Okay, just so you know that as well. Peter from North Yorkshire, Jack from Manchester, hello, one and all. Please don't forget to, wherever you see this, do all of that. I like a good night's sleep. That's why I need these boxes ticked, and that's what we're going to look at if there's any stocks at the moment. Now, when the markets fall, there are relatively few which tick all of these first 5 boxes: value, growth, income, cash return on capital invested, momentum, Sortino, which is average returns versus the downside being limited in size and durations. Size and duration, that's what the Sortino measures. And alpha, which is if the market goes up, you got more. If the market falls, you don't fall as far. Okay, well, obviously, we want all of these things. And I just cheat by looking statistically at which tend to exhibit these characteristics. Doesn't mean you're guaranteed to have them repeat in the future, because there are no market guarantees. A couple of days ago, every stock in the S&P 500 fell. Well, wait a minute. How can they all fall together if their valuations are so different, their growth is so different, their dividends are so different? Well, because momentum is an important factor. But they didn't fall by the same amount because Sortinos and alphas differed, okay? Anyway, we'll get into the meat of all of that as well as we progress. Let's just look at how that poll's doing. Suddenly, the majority of you don't think the FTSE will be higher by the end of the year. That would have been different even a week ago. Okay, let's see what you think about the Dow. Now, how's the past week gone? Lots of red. The bigger the box, the greater the market cap. Okay, there. Now, lots of red. So much for diversification. It goes to show that probably the best defense is cash, obviously. Do we need to be in cash at the moment in our pensions? Well, I'll show you that in just a second and how I decide and why infrequently I'm in cash. And it stops me panicking ever. So I'll explain all of that. But also, what does it show? And you might say, oh, no, you should be diversified. I should have had a bit of real estate, should have had some utilities. And I could show you other weeks where that would have been the absolute wrong thing to do. The point being, and I've written about this again in my Financial Times columns, when the markets fall, they're correlated to the downside. And there's academic data to back this up, which is where I get it from. Okay? So I didn't need to tell you that's been a horrendous past week. What does it mean overall? We'll come to. Past year, lots of green. Well, so much for diversification there, because it would have made no difference. Everything was going up. You could have been concentrated and you would have done perfectly well. In fact, if you were concentrated in a few of these tech companies, you'd done increasingly well, would have been incredibly well, and diversification would have been a drag on your performance. So let's not sort of just assume that those old mantras and cliches always work. And the reason diversification has changed is, well, not just because Warren Buffett says, put all your eggs in one basket, watch the basket, because the world is more interconnected. Okay, in one sense, all of these companies are technology companies, and if China sneezes, we catch a cold or COVID. If America sneezes, well, you can see with the American markets and worries about recession, the UK has a problem. So we're more interconnected than when those cliches were made in the 1960s, where diversification between industries, even in the same country, actually made a difference. Now, everything's so interconnected. And if you don't believe me, CrowdStrike, Microsoft, brings down the world's computers. We're very much more connected than we ever realized. ETFs I don't need to go into. For those of you interested in, shorting, which is high risk, or inverse ETFs, feel free to have a look at that at your own risk. They're there. I'm not going to discuss it here. I'm not recommending it by any means. In terms of the Dow, some of you are still voting. You're a lot more bullish on the US markets than the UK ones. I'll let you know, and I'll share the results of the poll in a second. Markets year to date are, okay, where are the markets year to date? Well, now it's a very important point I want to make to you. The markets can do one of four things. You might think it was two things, go up or go down. Actually, it comes into four patterns. One of which is they can fall, obviously. Let's call that one, all right? They can rise and then you lose all your gains, which is what happened here. And we're talking about a year when you're up, say, 9% or 7% year to date, okay, up in the first 8 months. So call that 2. You make some gains, you lose them all. It doesn't make you happy, or you have losses. That doesn't make you happy either. So that's 1, that's 2. Number 3, of course, is they go down. If you happen to enter in April or March or even Feb, you might be at a loss after 3 or 4 months. Even in an up year, markets can, sorry, I said down, up, then down. Oh, sorry, 0 was the third one. They go sideways, okay? So if you look at, let's take this period, they just go sideways. So many months, you've had 0% return. You get frustrated, you might leave the markets, yet the market overall ends up being up. And I'm sure this has happened to many people. They've exited because it fell and missed out on gains. They exited because their gains whittled away and they then missed out on subsequent gains, or it went nowhere and they exited and they missed out on subsequent gains. The fourth thing, of course, it can do, which is the bit we all want, is it goes up. Now, guess what? 1, 2, 3, 4 can happen in any order. Now, you can see here it's happened in a variety of random orders. Okay, it could happen like this. What we want, ideally, and we're not going to be able to control this, and there is 1 or 2 ways you can minimize which order it happens in, but for the moment, assume it's just random. Okay, you want 4 first. Everybody says, oh, but Alpesh, I don't mind having losses or losing my gains as long as I've had some gains to begin with. Well, yes. Well, my son doesn't mind having avocado as long as he's had ice cream and chips beforehand. Sorry, it doesn't work like that. There's an order. You're going to get your avocado and you're going to get your peas and you're getting your veggies and you're going to get your ice cream at the end. I'm sorry. Okay. The reason I mentioned this, and by the way, in a bull market, you'll get more 4s more frequently. In a bear market, you'll get 1, 3, and 2s happening. Notice how, if the market's just random, 4 is just 25% time. The reason I mentioned this is there's a lot of things to trip people up and get them off the market. Somebody once famously said, the job of the market is to get people out of it, which is how it feels sometimes. It goes down and you think, I'll get out. It goes up, you lose all your gains, you think, I'll get out. It goes nowhere for ages, you think, I'll get out. There's only one occasion. So that's why patience pays, or as Warren Buffett put it, the job of the market is to take money from the impatient to the patient. Okay, so that's where we are with that. So what does that mean for us? Well, I'm going to explain it in just a second. One of the biggest questions people have is, of course, I don't know how to decide what to buy. And this becomes the problem. They see the news, they read the magazines, they're on the internet, they're reading the newspapers, if anybody still does, they're drinking coffee. That's 1, 2, 3, 4, 5 things which are going to drive you absolutely bloody insane. And then they start chasing the market. So how do we stop all of that? So I have a process like anybody else does in asset management. You have a simple process where you're looking to tick all of these boxes: value, growth, income. As I've already said, they need to be all green. And I'll share something I bought over the past week, even in this market, which I thought was worth buying, and what I'm doing with the ones I've got at the moment. And I will look through 10,000 companies across various exchanges, including the New York Stock Exchange and NASDAQ and LSE, see what's good. I'll break that down. Once I've got those, I might then use a tactic to narrow that, to have a tie break, basically, to have a tie break. Here's a good, interesting tie break. As long as something has ticked all of these boxes, how do I then narrow that down? I don't want to buy 200 odd stocks out of 10,000 because it's about 200 which tick all the boxes. Well, I could look at, for instance, and this is bang up to date, the S&P 500 most number of guru holdings. Feel free to take a picture of this if you wish. It just so happens in a tiebreaker, the stock that ticked all my boxes and the gurus had, it was United Health. and it's one which I've purchased this past week. Now, here's something interesting. Notice how the markets fell, but these are still the biggest guru holdings. Because, like me, they don't just panic at the first sign of a fall, and they might want to hold on. I will discuss some of these going forward in this webinar, but I think it's interesting. So, darker the green, the more gurus. By gurus, it's an analysis of all the big hedge fund managers, and so everything from Warren Buffett to George Soros to Jim Simons and so on. Some of these might be short-term holders, others might be holders for a long period of time. And this is weighted not by the size of their holdings, but by the number of individuals, because some of them might only have 100 million, but they're a guru. Others might have 1 billion. Anyway, rough and ready. It's not a scientific approach. I thought it was interesting. That's one way. Another tactic on a tie break when you've got a bunch of stocks which tick all your boxes can be to look at analyst projections. For instance, if you have an analyst who has a high success rate and a high average return, you might have a look. I don't own any of these, by the way. You might have a look at these and see, as a tiebreaker, do they tick all your boxes for value, growth, income? If they do, you might think, oh, that's interesting. We've got somebody else there. Another tactic is to look at hedge fund projections. For instance, if you've got a hedge fund manager like this out of Marshfield Associates, who has a good track record, annualized 48% per annum for the last 3 years, I'd take that any day. And as recently as this individual has added to these, okay, I might say on a tiebreaker, does that tick my boxes of value, growth, income, cash? Remember, the tactic is the tiebreaker. The tactic is not the starting point. Unless you want to just follow this manager, that's up to you. That's a completely different thing. I've not tested that. I'm saying my first starting point is this. Does it tick value, growth, income, which is then scored out of, in my own proprietary algorithm, out of 10? Croaky, I'll come to Croaky later on. Momentum, Sortino, Alpha, and then tactically to break that down, you might look at those. That's up to date, by the way. In terms of his recent holdings. I don't own any of those other than Disney, which I had from earlier in the year, which hasn't done great, still holding on to it. And this one is not up to date, just so you know. This is not up to date. This is an old one. Again, you look at what the hedge funds overall might be doing, especially if a whole bunch of them are extremely positive on it, as a tiebreaker, and say, oh, look, Cadence come up with mine. It's also coming up with the funds. Let's have a deeper look, and maybe as a tiebreaker, it's what we use. For me, it comes down to basically these factors. I'm just scanning this, monitoring infrequently, once a fortnight. I mean, at the moment, I'm doing lots of videos for people because the markets are volatile, but I don't need to monitor my portfolio that frequently, because I will tick all these boxes so I sleep easy at night with 20 to 40 stocks, some in cash based on your own risk appetite. You might have 10% in cash, 20, 30, 40, 50 based on your appetite, your risk appetite. And you might have low volatility exchange traded funds. By low volatility, I mean under 10%. You can find that stuff out of the internet, but we can come to that later on. I think Yahoo Finance will tell you the volatility of anything. Sorry, this is a bit blurred. I'm going to come back to individual stocks in just a second. Okay. S&P maximum intra-year decline versus calendar year returns. So, for instance, so far this year, maximum 8% down, but calendar year return 13. I think that's slightly out of date, not very much out of date. Now, 5th of August, not very much out of date at all. So these are the downsides you can have. You can get a 26% return, but intra-year, you could be down 10%, peak to trough, okay? Yet overall, you had a 26% return, which gives you some idea of the volatilities you encounter along the way of getting great returns. I mean, 18% on the S&P, even though intra-year it dropped 34%, or 20% drop, although it gave you a negative return that year. Let's look at where you've got the widest disparity, 12% return, 11% peak to trough. What's interesting here is also, there are a few years, not many, where the drawdowns are pretty sharp. So we do need a way of ensuring, well, how do we know it's not going to be just a small down year like minus 7%? We don't want to miss the 31% gain overall for the year and exit prematurely. Compare that to 28% down, up 26. So I'm going to show you a way I use to decide once in 7 years usually is only time it needs to be activated, when to hold cash, whether it's a pension or otherwise. Now, I'm not going to go through all of this. S&P 500 drawdowns down at least 7% in 4 trading weeks. What then happens? Forward performance from the 7% drop. Within 3 months, most times it's up significantly. Within a month, most times it's up significantly. Okay, even within a week, actually, in most occasions. Interesting. Probably another reason Warren Buffett doesn't panic too much, because he'll be very familiar with all of this. Let's have a look at this as well. S&P, oh, by the way, I don't care if the market goes up or down. I'd rather it went up because I'll make money. But I'm not selling you a fund. I'm not your IFA. I'm not your wealth manager thinking, give me more money because I'll earn more fees off you. Hey, I'm just telling you the way I see it for my pension holdings. S&P 500 rose in 4 out of 6 occasions, 12 months after an interest rate cut. We're expecting an interest rate cut from the S&P. So 12 months after the cut, it tends to rise. Okay. Interestingly, over the longer term, 10-year annual return in sterling terms, so much for all those people worried about currency risk. In sterling terms, your 10-year annualized return is 15% per annum on the S&P 500. That's just an index tracker. That's not, oh, Alpesh, tell us some stocks. Forget that. Just tracking the S&P 500. Now, it might not happen for the next 10 years, but I'm just saying 15% per annum in sterling terms was the return there. And if it wasn't sterling terms and just dollar terms, because you just kept it in dollars, never converted it, it's perfectly fine because you're American, for instance, it's 12%. Well, I'll take 12 or 15. I mean, I know it's a big difference once you annualize it and compound it, but still 12 to 15, bloody hell. Thank you very much. I like that. This is from JP Morgan Wealth Management. Most of you think the Dow will be up by the end of the year. So that's interesting. Let's look at some other polls. Now, I wrote this poll before Kamala Harris became the presidential nominee for the Democrats. So where I've written Biden, please read Kamala. So let's see who you think is going to win that. Now, this is also pretty optimistic overall. Okay, I can take that. It should do wonders. Now, oh, by the way, FTSE All Share, just in case you were thinking. I mean, yeah, it's pretty poor, which is why a lot of UK pensioners remain significantly poorer than their American cousins. It's not just because Americans are rich and all the rest of it. It's because Americans, and your SIP and ISA can invest in US assets. But my God, the whole industry is geared against talking you out of it in the UK, or they'll say, oh yes, we'll give you a little bit. Here's a tiny bit, but we're so scared and petrified. We'd rather put you in British American tobacco, please, and Shell, and just stick to the UK oil and gas industry, please. Not all this risky technology nonsense. Okay. Sadly. Now, S&P 500 tumbles more than 8% from peak. How often does that happen, that 8% drop? Well, in one sense, these drops are frequent. In another sense, and remember, 2023 and 2024 have been pretty bloody good years. So again, a reminder of put things in perspective and context. One of the most important things I want to remind people of before we get into all the charts, sorry, I'm taking up half the webinar talking about all of this educational stuff before I get into where we are on the markets, is this, okay? Investments, I mean, you can read this at your own time later, take a picture of it if you wish. Very often, investors mistake themselves for traders. What they end up doing is they put greater sums than they would want to hold into stocks. They have a small appetite for falls, and so they exit at the first sign. They feel uncomfortable, like a 5% drop. They exit even if it's a small bear market, which they should really be ignoring. They might leverage when they shouldn't be because they can't take the risk. And they end up getting wrong-footed and whipsawed, as I've already explained earlier on. 1, 2, 3, 4. Remember, they don't get the 4. They get 1, 2, or 3, and that's it. And 1, 2, and 3 statistically will happen more frequently than 4. For me, I love what Jim Simons, the hedge fund manager, this was 23 billion. That's dated. It was actually 100 billion by the time he passed away this year. And this is the book I recommend you read. Okay, and this quote says it all. Success in investing is not about being right all the time. It's about minimizing losses and maximizing gains. I mean, to state the obvious. This is Microsoft, would you believe? You project that forward statistically. Okay, these are the range that it can come in. The point I want to make to you, the 95% range for Microsoft is between minus the 15% and up 136. So obviously a positive expected return over 12 months. The problem is most private investors will get spooked well before the 12 months are up, but also don't understand this. They think if it goes down, it's going to be, the rest of the year is going to be rubbish because they think the future has been foretold. It hasn't. It could go into any one of these paths. So I wanted to make that clear. It hasn't been foretold. Okay. That's also from Jim Simons, which probably is quite timely. I've been very lucky. I showed this last time and I'm proud of it. One of my students who was up 40% so far, well up over 100% over the last 18 months, and was kind enough to donate to a charity which I'm connected to, which helps widows and orphans. It's the only way I mean, this was fantastic when I got that. What a birthday present. Don't forget that. So where are we on the markets? Let's talk about the markets, okay? These are the various sectors. As you will know, I do not gamble on sectors because look at this. If these were horses in a horse race, even better, if these were Olympic races and you had to pick which one's going to win, bloody hell, that is difficult. At any given time, look at it. Who's in charge? Can you find a correlation? You probably can find a correlation because the human brain is fooled by randomness, as Nassim Taleb famously said. But in actual fact, I don't look at sectors. I prefer looking at individual companies. Of course, if the company is in the sector where everything's going up, it will do particularly well. But I prefer looking at the individual companies, and I prefer, when it comes to factors, ticking factors. So I like to tick the momentum and the value box, because you can have companies which are undervalued, showing momentum and growth and yield and low volatility, and then can be one of these caps. Okay, so you can tick a load of boxes, and that means you're not gambling on one factor, but actually you're reducing the dangers and ticking a lot of boxes instead. What about the markets over 1 year? How have they done so far this year? Well, it proves my point about 1, 2, 3, 4. The Nasdaq's up 18%. The S&P is also up roughly 18%. Okay, you might think it doesn't feel like it, but look at this. What I want you to look at in that time frame, by the way, on the voting, you think Kamala will win, so it's interesting. Okay. So I'll say it's interesting. What more do you want me to say? I don't know what's been foretold. You may well be right. Now I'm going to start another poll for you all. Here we go. And I'm going to go into here. Matthew, I'll come to JD later on. I think it's on one of the charts. So markets over 1 year. Look. What does an 18% look like, a return? And by the way, earlier in the year, it was nearly 40%. What does it look like? Well, it looks like a fall. It looks like 0% for absolutely ages. Look at that. That's 0% for ages. That's 0% for ages. Okay. It looks like gains all going back, losing gains. Very few times does it look like fall, i.e. going up, going up. Most of the time, an 18% gain is a 1, a 2, a 3. What did I say 1, 2, and 3 were? They were either falling, a 0%, or your gains going. It was either falling, okay, sideways, or a gain getting whittled away. Very rarely was it just a gain not whittled away. Put another way, all markets are delight, despair, delight, despair. If it's a bull market, fall will happen more often and it'll last longer, and the delights will last longer. 5 years out of 7, it's usually bullish. 2 years out of 7, it's not. In a microcosm of just a week or a day or an hour or a minute, these increase statistically very more frequently, obviously, because you're looking at a short time frame. So I just thought I'd explain that. FTSE 350 over the past month, these out of interest, just letting you know. S&P 500, where are we on that? Thank you, Haven. I wasn't expecting that. Thank you. I think I've lost a bit of weight. Gained a lot of shine. S&P 500, is this. Now, I'm going to repeat everything I keep saying every single week for donkeys. It is overbought. Okay. It is possibly a baby bear becoming a mama bear. That's a mama bear. Okay. So what are these bloody baby bears and mama bears? A baby bear is a small fall, which you could ignore. A mama bear is slightly bigger, which you might ease off some of your position if you're risk averse, but you could ignore if you're not risk averse. And a daddy bear is a steeper fall. Now, what you need to know is, how do you tell the difference? On a monthly MACD, which is a measure of short and medium term prices, if they're rising or falling, on a monthly, if it's rising, if the MACD, the blue dotted line, is rising, then it's a baby bear. If it's falling, it's a mama bear, and babies become mums, by the way. And if it's a daddy bear, it's this scenario, which is where the MACD from an overbought position, what's overbought? See this? It's the top third of this graph. Overbought position falls sharply through its own moving average, which is its own yellow dotted line signal line. Okay? Now, here's what you need to know. Daddy bears are rare. Out of every 5 years, maybe they happen once or twice. Mama bears, a bit less rare. So daddy has got 2 or 3 wives, okay? And they've got lots of kids, right? So baby bears are common, right? So they've spawned a lot of kids. So baby bears, i.e. the bits you've got to ignore, they're frequent. Babies can transition into mums, as they do in real life, and mums can transition into daddies. Enough said. Okay, so where are we at the moment? Well, we are, and you're going to like this. Where do I remove all those bloody ink from? They don't make it easy, do they? Options, erase all ink. I should know this by now. Where are we at the moment? Well, it might be a mama. It seems to be going from a daddy into a mama, and I'd probably say it's going to become a mama. And you might say, well, why don't you trade your investments and get out? Because I don't trade my investments. What if it becomes a daddy? Well, if it does, we'll wait, but those things are infrequent. Okay, Alpesh, well, how do you know what's likely to happen? Well, there's no guarantee, but it was like that here, wasn't it? And I've been saying this time and again that there will be drawdowns of certain depths and durations because they've happened before. And it might start a daddy. I don't know if that's going to happen. I do not know. I can say it probably won't because it's infrequent. Okay. However, this is overbought, and it was overbought here. And if we get a repeat of 2022, it will fall. That's what I would say if I was on Bloomberg today or the BBC and so on. Okay. So now you know where I am. What do we have at the moment? Well, it's a baby bear here. And when it was like this over here, you had these falls and you've got them again. Well, that's a bit steeper. Yeah, it is a bit steeper. Still technically a baby bear, which might become a mama bear, which is that one where that falls. And a daddy bear is this bit. Now, what would I do with the S&P and the NASDAQ? Well, if I really needed a really simple strategy, which I don't need, I'd probably say sell if it does this kind of pattern and buy if it does that. Or if you're really risk loving, buy if it's oversold and starts going up like that. Guess what? You would have made a killing over this period because you would have stayed out of this big fall and you would have got in very often. Now, that doesn't happen with all instruments, but with the S&P and NASDAQ, and there's no guarantee it would work in the future, it would have done you well. I've written about this first in 1997 in my book, Trading Online, actually, which was published in 98, became an international bestseller. Sorry, the second edition became an international bestseller. Not just because of that bit. Anyway, FTSE 100, so we are. It's dropped off a bit now. It's coming off a bit. S&P top 10 stocks over the past month. So given all these falls, Alpesh, should we have a look at these? Let's have a look at these. I don't own any of these, by the way. So let's have a look. They've all gone up significant amounts in the past month. So let's see what we might want to have a look at. That's neither overbought nor oversold. It's not in the top third, which would mean it's overbought and I wouldn't want to get in, or oversold, which means I might consider it in the bottom third, really. It's sort of here midway. In other words, I might have missed the boat. It doesn't hit my value growth income, but doesn't even meet me on momentum. So no, I know it's gone up. wasn't one for me. Sorry, I missed it. My job's not to be perfect and get everything. Missed this as well because, well, look at what it's done. And now it looks a bit overbought. Even though it's a 9, it's overbought, so not for me. DR Horton, it's a 7, but overbought, so not for me. That's a 7, and this is sort of midway between these two. I wish it wasn't so midway. I wish it was, we had a time machine went back here, which would have got us in here. And now it looks like too risky, especially in a falling market. I don't want to be buying much anyway, unless I've got a really good reason to. Nope, for that one. What about this? Sort of tagging along. I don't know. Is the dating market picking up? Some surge of single people? Not for me. And it's also $35. Anything below 100 usually tends to be more volatile. There's a general rule, but not a definitive law in the market. So, and especially given historically, these are pretty bloody bad months anyway. August, September, October for this. Nah, not for me. But Warren Buffett said the difference between good people and great people is great people say no to almost everything. Stanley Black & Decker, it's not a 7, 8, or 9, but on a momentum basis, sort of halfway in between, isn't it? And it really needs to break above that. If I'm not desperate to buy stocks at the moment, okay, but you know, it might continue higher and do okay, but it's not. I'm not in the mood. That's overbought anyway. So I know it's one of the big movers in the past month on the markets, but it's not for me. Bristol Myers Squibb. Now that is, if that crosses over its moving average, that'll be a safer bet and to get in. It's not hitting my value growth income, but purely on a momentum basis, might not at the moment though be one. But look, for goodness sake, you know, it doesn't exactly fill me with confidence or the rest of the market. While that's an 8, it's overbought, so not for me. Now there is a theory that if the MACD goes above its previous high, you could have some astronomical gains. And that theory does many times indeed work. However, when I first tested that about 25 years ago, and I haven't since, it wasn't consistent enough for me to pursue. But I want to draw it to your attention if somebody wants to do the data and the analysis themselves, because you've seen here, for instance, it's done it and then shot ahead. So you sort of buy when it breaks its previous high. It didn't used to work for me. I've not used it myself, but I just thought I'd share that. That's overbought anyway. Now, where are we with these? Now, for those of you who don't know, I consider the quality 5, what I call my quality 5, Meta, Microsoft, Apple, Amazon, Alphabet, the 2 M's and the 3 A's. And generally my rule is to exit if there's a daddy bear. In other words, that the MACD overbought crosses below its own moving average. Okay, for instance, I exited the position here because it wasn't from a very overbought position. I only sold half of it, as you'll remember, and then rebought again when the MACD started rising. Where are we at the moment? It's not a daddy bear. I've not exited any of that. Amazon, well, now you can do your own analysis. Now, again, with Amazon, you would have made a killing if you did what I suggested, which is, okay, you just sell at a daddy bear and you buy if this is rising, if you're risk loving, or if it crosses through the moving average, if you're a bit more risk averse. And if you did that over the last 7 years, there's no guarantee that'll work in the future. You know, strategies often are curious in that they sometimes work for prolonged periods in certain securities, and it would have worked with any of these. Microsoft, it's not quite a daddy bear. Now you might say, well, it looks like it's going to happen. It's going to happen. Why don't you just get out? Why are you waiting? Well, because, and if you read my books, Net Trading or Trading Online, actually any of the 18 that I've done, you'll see the research which shows from those that the MACD will often just touch its moving average and bounce up, and often bounce up significantly. So if you exit prematurely before it crosses below, then the danger you have is what happened here. You exit at the bottom and you miss that. Similarly, you exit here and miss that. You exit sort of here and miss that. You exit here and miss that. Okay, so you keep on messing up. And we know that now from the markets, that how often have people exited at the bottom of the market? That's before it just shoots up. That's a classic example of it and shows it to me. Meta, well, as you'll know, in April I exited this because I was in since January, and I needed to rebalance my portfolio. So when people ask me, what are you doing with that? What's your view? Well, it's not a daddy bear. If I held it, that would be the rule for exit. It's not. Okay, don't forget to look at all my YouTube videos on all of this. Now, Bank of America, I don't own, as you know. It's a stock market update, so I'm giving you more information. And look at this. It's dropped off a bit of a cliff despite this moving up. Okay, what's going to happen in the future? We don't know. We know this can move up, and you can get these massive pullbacks and then moves up. So if you don't like pullbacks of these durations, you shouldn't be in this or any other stock. You look at a little trick for you. You look at your risk appetite and you say, well, can I take this kind of duration and depth of drop? If you can't, DDD, draw down depth and duration. If you can't, then don't buy that stock. And assume as soon as you buy it, that's going to happen. That's how you work out your risk. How do you work out your reward? Project forward for 12 months and then say, well, what's the gain? Not just looking at charts, obviously value, growth, income, cash flow, Sortino, alpha, all the other things, but it really makes life a lot easier. Now, Netflix, I already said to you before, it's falling and it's overbought. You might as well just exit. It's not a quality 5, so you don't have to wait for a daddy bear. You can just exit off that drop alone. You might say, no, there's an upward trend. Yeah, if you're risk averse, just get the hell out. What are you waiting for? If you're risk loving, you might say, well, I'll wait till it drops, I don't know, 25% from the top before I get out. Walmart is a 7, so that's good, but overbought, falling. So if you want to get out, you would. Or you might say, if it drops X, I'll sell Y. Berkshire Hathaway, sort of puddling along there. I mean, it's done it before here, and when it did it there, it did this, and probably going to do a similar pattern. Nothing particularly exciting. This is one of the quality 5 plus, which is multiple years of significant gains, drawdowns not too steep, doesn't take too long to recover, and so you'd probably use the MACD rule if it's a daddy bear, and that isn't, i.e. moves below. Would I buy this today? No, I'm not buying anything at the moment. I bought United Health, that's it. I'm not buying anything at the moment. Would I hold? Yeah, until that exit rule kicks in. Would I sell? Only when that exit rule kicks in. Okay. What about ugly Walt Disney, which should have done so much better because it looked like it was just going to go at this amazing trajectory. And my cousin said to me, and she works in this industry, she said, no. And I said, yes. And she was right. And I feel stupid. I'm seeing her next week in Bali. I'm going to feel really stupid. It's now a mama bear. Okay, that's a mama bear. So we just wait. Unless you already had an exit based on if it drops 25% or X, then you'd get out. That's a 7. That's what you're waiting for to happen. Block. You're just waiting for that to happen. Charles River. Looks good, 7 plus oversold-ish, and weekly and monthly both moving up. When you get the weekly and the monthly momentums both in the same direction, you tend to get a bigger move up. However, the problem with Charles River is has these sharp pullbacks, which are quite significant historically. So you might want to avoid it just because of the volatility. If not, it looks okay. That's falling, so I wouldn't buy it now, even though that's a 7. This is just giving you a broader market update. That's a 7. Well, at least that's moving in the right direction. I'm not going to go through all of those. You've got all of this. You know about my campaign for $1 million. I've added a few more charts to the biggest mistakes people make with their pensions. For those of you with pensions which aren't performing well, thinking, well, actually, do you want to take control of it? Well, one alternative is you can just do what Warren Buffett says, have an index tracker like an S&P 500 and a simple strategy around it, as I've shown you today. Or you might say, well, actually, I want the transparency of seeing the data of all the stocks and knowing what I'm buying, why I'm buying it, and why I'm holding it, and dividing it between the ones which meet your due diligence, which is the data I give you, value, growth, income. Okay, you want to make sure you've ticked all these boxes, otherwise you're just flying blind. And then you decide how much should be in cash, how much should be in low volatility funds. Okay, volatility under 10%, still also with Sortino and Alpha and all the other factors, and how much in stocks, and whatever percentage is in stocks is held for 12 months. Then you do the exercise again, and you might have 20 stocks, equal money in each. Okay, and your exit rules are, if it drops 25% from the peak, you would sell. Very simple. At least you've got transparency and you're in charge, you're in control. The biggest mistakes people make is they don't know when the markets fall what it means. I've given you today what it means, okay, and when you should worry and when you shouldn't. Because what we're actually after, and this might never happen again, because history isn't guaranteed to repeat itself. It just isn't. I wish it was. Okay, but a 54% return was astronomical. It was great. I would take that any day of the week, obviously. And when we had that, which is more than I ever expected, it was composed of, now look at this, 208%, 137, 135. So wait a minute, if you've got these big returns, why have you only got 54? Because there were a whole bunch which went nowhere and brought the average down. Oh, well, why didn't you just pick that? I wish I could see in the future. Do you see how returns are made? Few outliers, the vast majority, a few little gains, little losses, and stop losses to stop any falling too far. Okay, thank you, Viola. I'm absolutely, absolutely delighted. Mistake number 4, not having an exit plan. Now, I'm going to give you an easy one. 12 months and then restart again. I know it's oversimple because you might say, well, would you really sell NVIDIA after 12 months? No, you'd adopt the rule, if it dropped 25% from the highest point, or X, if it drops X, you'll sell Y. Now, this is very simplified, but at least you've got something better than nothing. The other problem is people don't realize this is what their pension fund manager is charging them, which is why I want them to be in charge. You would expect me to say that. I had a Bloomberg TV show teaching people how to invest, my Financial Times column, my books teaching people to invest. What do you think I'm going to say? I want you to learn how to invest. And you're going to turn around and say, sorry, that's not for us. We just want to know what you think. I appreciate that. Look at that. 10% is what they're charging you on your money over 5 years. That's nuts. Okay. I want you, because this is somebody who wrote into me, my own pension provided by Legal & General. This is provided by my employer. The information was shocking. 20% growth between 2012 and 2022. Not 20% per annum, 20% overall. Please check. Call your HR department. Ask them, what have you invested in? They'll give you a list of names of funds. Now find out what those funds have invested in, because it's individual securities they'll have invested in unless they've got bonds. Okay. Because you need to know what it's in and why. Okay. And then ask them, how did you do in 2022 when we held cash? Because we have a very simple rule. If it's a daddy bear, MACD falls below its moving average, you hold cash on the S&P 500. Okay. So ask them, Alpesh held cash, got 0%. What did they get? And they'll have had big losses, I'm afraid. The question then arises, is 40% realistic? And the answer is no, it's not. You need these conditions, which rarely happen, to happen. If the market has a tailwind like 2021, 2023, i.e. if the rest of the market, the whole market's rising in a rising tide, all boats rise. If you've picked high Sortino stocks, those with high average returns, with low volatility, low downside, high alpha, i.e. market goes up, they really fly. If you're not just looking at the UK and emerging markets, because it's just too few companies, okay? US, I think, still, because I've got 10,000 companies there. If you can go to cash in bad years like 2022, the MACD rule I just gave you, it's really simple. Okay, if you can monitor once a fortnight, not every single minute of every single day. If good years make up for bad, like in 2020, people ask me, what's your average return? Well, in 2022, it was 0%. And in 2020, the year before, it was 50%. Well, that's not normal. That's not average. 0 isn't typical either. Okay. And I only look for stocks where if I project forward 12 months, can I realistically get 40%? Does it happen every year? Obviously, bloody not. In 2022, none of them did that because I had to hold cash. I need croaky stocks, i.e. the ones which Goldman Sachs say will give me 30% per annum. I'll come to that in a second. And if I hold for 12 months and then reevaluate, okay? And sell anything which drops 25% from the peak. There are tweaks to that, nuances, but that's the general rule. Okay, this is what happened last year when you get to that list. Is that typical? No. Will that ever happen again? Probably not. Oh, but Alpesh, you only bought what everybody else did. Yeah, you're right. So what? But those ticked our boxes. Okay, wait a minute. If you use that approach of all these boxes being green, how come they're not green? Because by the end of the year, they won't be. They shouldn't be. By the end of the year, it should be over-ripened fruit you wouldn't want to touch. Well, wait a minute. If you use the same approach, why is one all the way up there and one all the way down here? Why didn't you just buy one company? I didn't know it was going to go up 238%. And this just shows you the variance of what happens. Same approach. Same with Warren Buffett or anybody else. My God, if you had one holy grail where you knew something was going to go up with sufficient certainty, you just put all your eggs in that one basket. You don't. This is what diversification is, having 20-odd picks or so. Okay? Now, if I get a good year like that, it might only happen once in 7 years, once in 2 years. Oh, sorry, once in 7 years, twice in 7 years. If I'm lucky, 3 in 7 years. Well, and let's say the rest of the years are mediocre. Maybe there's 0% gains the rest of the year. Well, what happens to your pension is it shoots up, and then the rest of the time it's like, not doing much, shoots up, not doing much. It isn't going to go like this. That's how actually investing happens, sadly. I wish it'd go up just like this, but it doesn't. Okay, there are years like 2022. Out of every 7, roughly 5 are up years. Some blow the doors off, some mediocre up years, and 2 are 0% years. Okay, roughly. What about the future? I might never make a profit ever again because the stock market isn't physics. I don't know what the future holds. The Russians might launch nukes tomorrow morning and we're not here. I don't know. I can't guarantee anything about the future. Okay, assume you plan to invest over 10 years. Let's say you can do 20. Remember, the S&P is 15% per annum. Let's say you do 20, a little bit better, and you might be happy with the S&P. That's perfectly fine. 100 in your SIP, ISA, 401k, whatever. 1.5 each month. 1 million by the end of 10 years is what you'd have. That's how it works out. So why doesn't everybody do it? For a very simple reason. Look at where the big gains come. They come at the end of that period. Now, when you're old like me, you realize 10 years goes like this. When you're in your 20s and you've got very little money and you want to go to the movies, let alone date night and everything else, you don't do that when you're 10 years married, obviously, then money's tight and you don't even see much growth to what you've put in. Okay, that's why people don't. It's all very well going, compound. Who the hell wants to compound if the gains only come later? The most successful people in the world are those who can delay gratification, as you all know, and there's academic studies on this. But of course, you don't want to delay it to the point of being bloody miserable for 6 years. But anyway, that's the data. It won't go up like this. It'll go like this. Okay, it'll go like that. That's how life works. Okay, the goal is by the end of those 10 years, you've got, through that passive income, as Warren Buffett full well bloody knows, lucky man, 100,000 a year. That was your initial capital. That's just profits every year. That's the goal. Okay, forget that bit. Doesn't matter. Somebody once said, well, you only ever show this, you don't show anything else. Actually, I show a hell of a lot more. So on Bloomberg, we ran a competition. The Financial Times did one. And it's in my books. And Channel 4 did one. I won all 3 of those. Channel 4 did multiple ones in Show Me the Money. It was the year in which I competed, I won. In the years I wasn't competing, I wasn't competing. Okay? Consistent approach, rules, processes, like any other business. There is no flying by the seat of your pants. I'm on an airplane tomorrow. The pilot will not be flying by the seat of his pants or her pants. Okay? There'll be a process. There'll be a checklist. Right? Now, cash, low-risk funds, stocks. Of the stocks, 20 to 40. It's like that. Okay. Oh, Ravi, hey. Oh, thank you for your message. I'm going to see if I can publish that. Thank you very much. Very, 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 very good. Broadcast comment to room. Very kind of you to do that. What broker do you use? Rashid, because I've written books on this, I've got more brokerage accounts than a normal person would because I want to test all of them, a bit like Martin Lewis. But I have no problems if you had AJ Bell, if you had Hargreaves Lansdown, if you had Interactive Broker, if you had Interactive Investor, Free Trade. What I would say is any instruments you want to buy, before you open the account and go to all that trouble, just check that they do offer them because many of them don't offer all those things. I don't particularly like Vanguard. I don't like Best Invest because I think that their offerings are very restricted in terms of what they offer. So, compare them by saying, listen, I want to buy $5,000 of Microsoft and ask each one of them, what would the cost be? Okay, and you'll see the differences. Let them do the maths on it over there. That's who I am. As you know, there's copies of my books, as I've said. Now, I want to tell you, Croaky, why do I look at this? Now, it's not vital. You don't have to. It's a nice to have. It's not a must have. But I think it's pretty important. And I got this slide from Goldman Sachs when I first launched my hedge fund in 2004. A few years later, I was invited to a dinner by them. Sorry, a lunch. I'm from Yorkshire. We call lunch dinner. A lunch by Jim O'Neill, now Lord O'Neill. And they showed this and it blew my mind away. Basically, it is companies with cash flow available on the capital invest. Imagine a company which buys some plant and it produces sweets and they sell the sweets and it they sell the suites for lots of money, and the plant and machinery they don't need to change. Well, that's high cash return on capital invested. By the way, that's the example Warren Buffett gives for why he owned Sears Candy. What they discovered is companies in the top quartile by Croakey generate 30% per annum returns. Not every year, like the financial crisis, nobody did. Okay, so that's why that's important to me, is to get that type of well, I want the Croakey box tick. Now, it's a nice to have, not must have, so don't go nuts if you can't get it yourself. This is from Goldman Sachs research. I like to borrow other people's research. If it's from Goldman Sachs or Nobel Prize winners, and the three that I love, Richard Thaler, Daniel Kahneman, sadly Kahneman's passed away, and Eugene Fehmer. Fehmer and Thaler are still alive. Their work is great. If you look at my free resources on alpeshpatel.com/links, you'll find their research here. See where it says free investing course? You'll find it there. alpeshpatel.com/links. It's free. You'll find the free research there. Okay. I sometimes mention it on my LinkedIn. Feel free to follow me on LinkedIn. It's also through alpeshpatel.com/links as well. It's all free there as well. Okay, so going through that. Now, this is a typical portfolio of what I've been sent by somebody in the past. And you can, we analyze this sometimes and you see the gaps. There's very little greens. You can see why their performance has been really poor. Their IFA or somebody has put them in a whole bunch of spray and pray. Yes, they've got some bond funds. I have no problems with that. You know what? My Wise bank account gives me 4.9%, and they pick the JP Morgan funds for me. And that's just bank account. So cash should be generating 4.7%. I don't need these complicated instruments to bloody well try and do it. And so what do they end up with? Well, Scottish Mortgage Investment Trust fell 50% in 2022. That's why I ask them how they did in 2022. It worries me what they do. Fundsmith for the last 4 years has not risen as much as its benchmark, which is the FTSE, the MSCI World Equity Index. It says it doesn't have a benchmark, and then it gives the benchmark, the MSCI. It hasn't risen as much, and it's fallen more. When there were falls, it's fallen more. When it's risen, it's not risen as much. In other words, pretty piss poor. You might as well just put it in the MSCI. By the way, S&P 500 or the MSCI World Equity Index. You can find it on the internet. They're probably two good exchange traded funds if you don't want to do any picking yourself. But just remember that MACD rule I told you as to the 1 year in 7 you have to hold cash. Okay, so they shove it into order. They spray and pray and get piss poor performance. That's typical, absolutely bloody typical. Bruin Dolphin, stock spread over 1,000 different companies, scattergun effect. Just be aware, who was it? Rashid. Please be aware, when you open an account with any broker, they will try and send you lots of marketing emails as to why you should give them funds. Okay, Fisher, similarly, put it into their single fund, spray and pray, same old, same old, same old. I want to turn the market around. What I want to do is give 99% of the people free education. There'll be 1% who'll say, actually, I want your data, but I don't want to pay for it every day, every week, every month without subscription. What I want to do is like the Airbnb model. I'm from the asset management industry. I don't want to have people's money. You might think that's weird. No, Airbnb doesn't own properties. Uber doesn't own cars. Okay. I think an asset management company, to be revolutionary, shouldn't own assets. I think the client should own the assets with whichever broker they want, and they should have the transparency of all the data and the knowledge to know, if it's all greens, what to do with it. They should have the knowledge to know how much, based on their risk appetite, should go into cash, how much should go into funds, how much into equities, and which equities. Simple as that. They should know when to exit, and they should make the decision because they should have that transparency and control. Ideally, that's only for 1% of the people. That's my goal. These are 4 people who worked for me. None of them had a financial background. Straight out of university, Kirsty went on to become a pensions lawyer. Pensions. Naomi, a fund manager. Susan, head of communications at Wells Fargo. Kanira in the venture capital industry. Nobody had a financial background. The point is, investing doesn't require a financial background, contrary to what people want you to think. What it does require is a process, like with anything else, for success. Okay. The reason this idea came about to me was when having being in the asset management industry and on the venture capital side, the private equity side, and the hedge fund side, is realizing that the long-only fund managers are ripping people off because they don't tell them they can't go into cash in down years like 2022. And there are simple rules, as I've shown you tonight, of when you should go into cash. Okay. And they will just spray and pray into a whole bunch of stocks because they get lots of kickbacks, and the IFAs and the intermediaries are getting paid to keep telling you to be in the market. Whereas years like 2022, you should not be in the market. And I don't mean that with hindsight. I mean that during that period. The ideal for me, and it's only for 1% of you on here, is the people who want the transparency of the data and want to do it themselves. Others, they don't, and that's perfectly fine. I want to reach 1 million people globally through the internet. You can do that now. And teach them how to, through teaching them investing, how to add an extra 1 million to their pensions over their lifetimes. Now, obviously, if their lifetime is they're going to die tomorrow, it might not happen. But you get the point. Over a prolonged period of time, give it at least 10 years, turn 100 into 1 million by teaching them how to invest. Okay, that's the idea. That's the idea. Ian, great concept. My pension is in drawdown. So any tweaks on what you've covered so far? Ian, that's a really complicated question. I'd have to think about that. I'd have to ask you a lot of questions before I could even come to giving you education or information on that, I'm afraid. I'd probably say if you're in drawdown, you're older, and therefore you probably want to have a bigger amount of just cash rather than being fully invested in the market. And you probably want to have the lower volatility stocks, maybe lower volatility funds, exchange traded funds. Volatility under 10% is probably what I would have thought. So when we launched all of this, we had all these interviews and videos with people for that reason. Okay, let me end the other poll, by the way. What have we found? Underperformance has been the biggest complaint people have had on the poll. 43% said that. Fees, 16%. Underperformance comes up as the most. Lack of transparency, that's why I want people to have the data. Fees, that's why I don't want to charge people anything every day, every week, every month, every year. Okay, here we go. That's it. That's why I launched that from my industry, because I think I want to revolutionize the fund management industry. I think, so many things get revolutionized. Nobody's ever done that with the fund management industry. It's still fund managers taking lots and lots of money. I think the biggest revolution was exchange traded funds, okay, trackers. And I wrote about those 25 years ago in the Financial Times, so they're not even new. And they weren't even new then. They were just taking off then. But yeah, if people want to be part of it, more than happy to welcome you on board and answer the rest of your questions. Let's turn that off. Okay, over there. And this is what I do. Most people just want the data. They want the data and they want access to me, which is fine. My job is to be one of two things: either a driving instructor teaching you how to drive, so you've got unlimited access for life to me, or the sort of McKinsey consultant or Goldman Sachs specialist who comes to you and says, Mr. Chairman, you're the chairman, okay, says to you, here's the data, here's the short list, and you go, well, I've got the data, I've got the short list, explain what it means, and you do that, and they go, right, fine, and then they select the decisions, you make the decisions. And I think that's really important. I think that's how it should be, because that's how I've been doing it, and I think that's how private investors should do it. Obviously, I appreciate most don't want to, most just want to bury their head in the sand and give it to an IFA and hope that good things happen. But there is a minority globally, and we've got people from New Zealand to Canada who want to do it this way instead. And that's the bit that I'm really talking to as well at this. And even if you decide to do it yourself without my help, please remember value, growth, income, cash flow, Sortino, alpha. Okay, remember all of those things. My idea with this is it should be a no-brainer. We've got a few business people who said, you know what, no-brainer. Because if I can get a 20% on a 500K, that's 100K. Even if it takes you 10 years or 1 year or 2 years or 3, or if there's the down year, there's 0%, at least at some point, that gets me the leap up. Might be flat, then leap up, flat, leap up, flat, leap up. That's what it should be. If it's not a no-brainer, it's not for you. Okay, it's as simple as that. Sorry for the garish lines. I was told that So you make. I'm going to answer some questions while I put that up on the screen that I might not have answered so far. So please, any questions that I've not answered, because I want everybody always to be left with something great. Mama Bet, like to go lower and buy slowly on red days. I'm in S&P 500 mid-cap ETFs. No, that's not what I do with a Mama Bear, but you might. That's perfectly fine. With a Mama Bear, I'm usually not buying anything. Hi, Alpesh. Certful is that. Thank you. I'm around 40% cash currently. Any thoughts on what timing to invest this? Keep watching my weekly updates. I don't know whether, as I said today, no. I bought United Health. That's it. And you should be happy waiting. And I'll tell you why, because Warren Buffett's happy waiting, because when the markets fall, you're going to make your money later, and you're going to make more of it. Don't forget alpeshpatel.com/links. Okay. Over there, you're going to make your money from that. Let me see the other questions. What broker? I think I answered that, Rashid, in terms of brokers. Croaky stocks available to the public. I don't know if the data is available anywhere publicly. I calculate it myself, but like I said, it's a nice to have, not a must have. So don't get too hung up on it. It's a cash flow measure. So you can substitute it by looking for stocks with good cash flow. I think Yahoo Finance is a free source of tons of data. If you want free charts, you can get free charts from tradingview.com. It's free. Okay. On there, I think there's one or two limitations with most of these things. I think Koifin is good for free resources, though I think, again, they charge. Most of these are freemium. They charge a bit for some extra things. I think Yahoo Finance is largely free, if not entirely free, actually. You guys are the closest to DIY. The only things you've got missing are these two. IFAs are probably the bloody worst, I'm afraid. Now, I know IFAs have other jobs like financial planning and all the rest of it, and that's great. But in terms of picking funds and stocks and all the rest of it, bloody useless. Don't take my word for it. Eugene Fama won a Nobel Prize in economics for proving IFAs are bloody worthless and fund managers are worthless. Nobel Prize in economics, 2018, I think it was, for proving this. I didn't say it. I'm not just having a go at them. They get very touchy when I point this out. Okay, do you expect markets to rally post cuts? My expectations were irrelevant. Jim Simons famously said, we don't care about what we think. We care about what the computer tells. I'll let you know when it happens. Don't let my expectations bias you. There is not a column in the stock market which says value, growth, income, Croaky, Sortino, Alpha. What does Alpesh expect? I'll know when it happens. I thought 2022 was going to be a good year. Luckily, I held cash because I followed the computer, not my views. I thought 2023 was going to be a bad year. Luckily, I followed the computer and we made a stonking great return, not my views. Okay, I am not the guy off Billions who, by the seat of his pants, goes, hey, guys, I think there's going to be a takeover bid for so-and-so. We've watched where the jets have been flying out of, and I think the law firms are talking to each other. That's not me. Look at the data. I showed you the data. I'm data, not narrative. Okay, so sorry, Rashid, no idea. And if I was on TV, I would say the same. What I would say is the data suggests post-cuts, within 12 months, the markets are up. That's what the data says has historically happened. Okay, and I could make a case for it going up. I could make a case for it going down. But I do think certainly in the near term, we need, as I showed you with the S&P 500, we need some of that drop off. Okay, some of those falls I think are going to happen. I'm going to just go through the charts in reverse. Okay. On this, yes, it is a one-off. There is no ongoing charge. Okay, are there any other questions? Ravi, I fly to India tomorrow. I know we were supposed to meet. Ravi's on the program and we're supposed to meet, but I just got back from Spain. I'm flying to India tomorrow, but I will have my computer with me and I will be doing lots of broadcasts because I'm flying solo. So it means I get to look at the markets. Lots, and especially at this time, I just love it. It's not because I'm necessarily doing anything with the markets during that period. But I've not had to change my portfolio drastically beyond just some of the leverage positions came off. But then, if you remember, I did most of the drastic cutting and pruning in April. If you remember, prematurely, some might have said, nobody did say that. But in hindsight, I thought, it was a bit premature because May and June and July were massive uprises. But so I didn't need to do much, because it should be that in a falling market, you don't need to do much. Just as Warren Buffett doesn't need to do much. He's taken off some of his Apple after 5 years. Well, he's rebalanced the way I did in April. So right now, he doesn't need to panic and sell or anything else. Okay. When am I next on TV? Somebody just asked me that about the BBC this morning. GB News have me on quite a bit. I don't know. August is pretty quiet. I used to do the newspaper review quite frequently, and then they changed during COVID. So I don't know. Do you know, I'll tell you the funniest thing about being on television. I've never had a PR agency where the job has been to try and get me on TV, like so many people have. It's always been, if they want me, I'm here. The time anybody has ever worked for me, for instance, in my firm, and said, oh, we've got an announcement, we'd like to be on air to discuss this, this, or this, it's never worked. So I've never bothered ever since. Like when we launched our fund, we didn't get any coverage. Nobody cared. So I just let them have me as a whenever they want. So I don't know. To be honest, now after 25 years of doing it, it's not got the same thrill it once had. And my God, I certainly don't want to be talking about socioeconomics at the moment. As I get older, I'm sort of less banging the table about stuff. I'd rather, I don't mind talking the markets. I'm just going through the slides in reverse because it usually jogs people's memories quite nicely about the various things as well that we're going through. This was a good one. If there's no more questions, I will also just now, for those who've signed up, I will send you an onboarding email shortly in just a second. So you will see that. So there's no, just give me a few moments to send that across. And if there's no other questions, I will speak to you probably on Telegram. Again, look at alpeshpatel.com/links. And you can see there, and you will see everything on there about what I am, just checking there's no other questions, what I'm doing and planning and all the rest of it. So thank you all very much. Oh, I've got events which I do open up to my clients, but also more broadly to the public. They're free events, and I will put it on Telegram. I think the next one will be October, because obviously August and September are a bit quiet. Will be October. So I might see you in person, but have a look on Telegram. If you want to know where my Telegram channel is, it's alpeshpatel.com/links. Okay. Thank you all very much, and wishing you a safe and peaceful evening. Let me see, where am I? Move, turn off screen share. Safe and peaceful evening. Thank you all very much indeed.